Thank you so much for all of you to be here, and I hope that you all feel fortunate because you have people with real experience here. We have 30 minutes on a subject that could take hours, so we're gonna jump right into it. I'd love for you to basically walk me through some of the exits that have worked really well for your portfolio companies, the form of exit that have worked well. I don't know who wants to start and to describe it for us. Maybe I'll start with you.
Yeah, so I'm with Launch Africa. We are an early stage fund. Our fund one had over 130 companies. For what's worked for us in 2025 really, really well has mostly been a lot of secondaries. The benefit of having a large asset base is that you also get lots of opportunities to do secondaries. That's what kind of we focused on this year. A little bit of M&A as well, some that the founders got to us, some that we had to help introduce and maybe help even structure. But I hope that in the future, we're going to work on more and more competitive M&As, hopefully also look at listing some of our more growth assets in the portfolio in different exchanges on the continent.
Awesome, M&As and secondaries for you. What about you, Benoit, at Savio?
So welcome to everyone. My name is Benoit. Just to share with you, we raise our two funds with private LPs. So when you have private LPs as a shareholder, you need to provide proceeds every year. So every day I have some calls from my shareholders. What will be the Christmas gift for 2025? And at date, we did 5 exits, full and partial. So I don't have the secret sauce, but we know how to exit companies, Anglophone companies, I mean Africa, and Francophone companies. That's kind of Iron Man, because we need to structure the deal, we need to prepare the entrepreneur, and we need to find the acquirer. That's the most difficult thing. But we did, and we can show to the market that it's not a miracle to sell companies in Africa. That's possible.
And that's an important message because we need more people to be attracted to investing on the continent. And it's also nice that you're sharing about the pressure that you're receiving because for founders, when your investors are trying to exit, it's because we also have pressure in the back. Keith, do you want to share a bit more about what has worked for you?
Yeah, I think that we'll get into the meat of some secret sauce just now, maybe the source of the meat. But so I'm from Life Capital. We have had various exits. Remember, a failed company liquidating is also an exit, so we had some of those. But the ones which are nicer to talk about is, so South African companies, we've exited to General Electric, to Visa, to Garmin, KKR, SoftBank. We've had exits to Ticketmaster, Uber Eats. So these things do happen. I think some of the other things that I do want to touch on as well is exits which are actually a MBO, management buyout of the VC, and those were actually some of our most successful ones, where there are inbound interest, there are offers, there are a bit of a bite at the cherry, and us as a VC saying we need to get out, we need to set returns, and we basically play our poker hand to the founders, saying, well, we're quite happy to exit at this thing, and they're like, well, we've got seller's remorse, and we want to take a second, wind at this company. We actually want to turn it into a permanent, we don't want to exit anymore. That's cool. So then it's not that easy. You can only do it with a profitable, leverageable business. But we've done some of those which were also quite successful, which we're quite proud of, supporting founders to buy the company back.
And it's important to touch on those different models so that people also understand what they need to do if ever they want to regain control at some point of their company while making everybody happy, right? Aladdin, what has been your experience?
So I think our experience starts on the very early stages when we actually decide to do the investment. And there are two perspectives here. I think definitely there is the investor perspective and what we're looking for. And there's the founder perspective. And majority of the time, we kind of try to preempt exactly what would be our position in a 4, 5, 6 years from now at an exit position to make sure that we're also aligned on the incentives with the founders and to exit at, let's call it the most optimum point. Although it's very hard to identify it and it's very hard to time it both together. Most successful exits for us are the ones that are reasonable within the market conditions. And I think it's something that we've seen multiple times, few of our companies during the past period getting an acquisition offer, we can push for it, similar to what Keith have said, and say like, hey, we are open to an exit. But I think also setting the realistic expectations with the founders are the ones that usually generate the best outcome and the best exits. We've made some good money, but we've also lost some money, and the main reason is we are not realistically looking at where the business stands, where it can grow, and at what cost, and from where. And if we would grow to that, like that much, from where we get that capital, whether debt, whether equity across the continent. So I think the balance of all is really important, and when it comes, I think you need to consider to kind of to take it to returns for LPs, but also to open up and provide more liquidity for more and more founders to come into the market.
Absolutely. The signaling effect is really important. And you mentioned, and I'm going to stay with you just for a second, because you mentioned the relationship with the founders. The reality is, at the end of the day, we are investors, so we don't control the companies. And there are certain habits and certain things that the founders also need to do to make sure that they're positioning or setting themselves up for success. What are the key habits that you've seen, or just the key structures that founders have put in place that have really helped to get to a successful exit?
That's a great question. I think for us, it's two things, maybe three. I've tapped initially on one, but founders knowing exactly why they are building what they are building, and probably from the very beginning, it might not be so common, but actually we find it a lot. Founders knowing exactly when, where they're going to sell their company. And from the very first day, they are building a company with a certain structure, with a certain trait, knowing exactly what they are after and what they're trying to solve for, and potentially we're going to sell to 1, 2, and 3, 4. And actually, we adopted this mindset from our discussions with some of the founders in terms of how we assess opportunities as well. And we started to have this discussion around, if we would sell this company, who precisely? We can stay very high level around kind of whether M&As or listings or roll-ups, even potentially at one point. But we try to go as much in detail to identify who's the actual potential buyer from the very beginning. It could be someone very different at the very end, but we'd like to have that visibility, and we'd like to build this through. So that ensures that there is some sort of alignment, but also strategic sync between what we have from an expectation perspective as a fund and what the founder also what the founder had from an expectation perspective, so we can build both together to that point. And it helps us a lot to have better dynamics with the founders, and leads to kind of better results. And in fact, and that would be my final point, the ones where we had majority major challenges with exiting a position, which usually related to dynamics between different shareholders, is the misalignment between the incentive and why we're doing this and why this is the best time. Then it changed significantly from being a company-first discussion to stakeholders discussions or different incentives discussions, right? So we try to kind of tackle these kind of points early on from the very beginning.
So what I'm hearing here is that it's important as a founder also to manage the alignment with your VCs and to be very intentional from the get-go if you're trying to have a successful exit. Keith, what has been your experience on that front?
Yeah,
what are the habits?
Absolutely. But I think the more on point on the secret sauce from our experience is, and one of the reasons why we are such a lack of exits in across Africa is, you have to be creative. You know, these things don't just happen. They sometimes fall in your lap, but hope is not a strategy. So you have to be deliberate and creative. And I think as a investor group, and I'm saying LPs and VCs and co-investors and secondaries, I think we're still stuck in traditional, well, there's an M&A, so this is Africa. Rules don't really apply like it actually usually works. And we need to be as creative in building our business models as we need to be creating exits. So firstly, I would say secret sauce is, it's not in a textbook, it's Africa. It works differently. So, but then, if you think about two corners, in the one corner right now there are meetings happening, assuming that we're talking about a strategic exit to a strategic acquirer. I mean, we have to talk about listings and IPOs and those things. It's a whole different panel that we're going to have about how to fix that, but you know, some of us are working on that as well. But someone's having a strategic meeting where the exco is talking about how they should get into emerging markets and maybe look at Africa in whatever vertical that may be, fintech, health tech, whatever. Then they're going to appoint McKinsey or Bain or whatever to scope the market. Then they're going to come back with a very expensive report and tell them these are the companies to kind of go after. And then they're going to reach out and go through the DD and the diligence and stuff. So that's a little bit uncontrollable to a degree. In the other corner is your company and your investment. Just build a kick-ass, awesome business, because you need to get noticed. And companies who actually disrupt stuff, interesting things happen to those. So build an interesting company first and foremost, then know who these people are who are potentially going to have these meetings. You know, if it is a quicker ticketing business, it's not that hard to anticipate that maybe at some point Eventbrite, Ticketmaster, these guys may or may not want to enter this continent in large. Build a acquirable business, you know, in terms of data room, financial models, big enough, clean enough cap table. So clean up what you can, and basically present this thing. So when and you need to know, you need to get noticed. So meaning the PR things, getting on stage, pitching, all those type of things, the awards. It's a different game. It's not to say, look at me, look at me. It's basically to make sure that if there is a Brighter Bridges report or Africa Arena report or a thing, those are the things that AI and the lazy analysts at Bain and McKinsey are going to pick up and present these companies, so you get into the top 5 radar. And then from there onwards, obviously, the table stakes is the M&A game. Once the matching is fine, that's gamification. But once it happens, you need to have a kick-ass team behind you to execute.
So what I'm taking away is discoverability. Like, you need to be discovered, and you need to also make sure that your house is in order, including your cap table. That's something to be very, very intentional about. Benoit, what has been your experience in terms of the best habits you've seen in founders that has helped from an exit perspective?
First, we are not chasing unicorn. We don't believe in IPO, we don't believe in unicorn. So when you are an entrepreneur in Africa, and especially in West Africa, Francophone country, you need to create an African champion. And what is an African champion? Is a profitable company. You can have a peace element, you should have customers, you should have a team, but the only way to exit your company for the moment is to go to a corporate. Logistic, fintech, insurance, marketplace, and the rules, you need to reach 5 million euro revenue to be profitable, and then you can start your process. The idea is not to raise funds and funds. It's not to do your Series A, Series B, Series C. It's one day you need to exit, you need to make money. And we prepare all the entrepreneurs to that stage. So when we invest, the first exercise that we ask them, who will be your acquirer? You need to find a way to work with your acquirer. That's why the path for exit is to have the first revenue with your potential acquirer.
I love this. There's, again, intentionality. And I've seen also people having also their potential acquirers already in their cap table too. So they have like first views on it. I'd love to have an understanding about what you've seen. And you've seen a lot of companies. Launch Africa, you have one of the largest portfolios on the continent. Yeah.
We do. And I kind of want to take a few conclusions. For example, Keith says, hope is not a strategy. And we're one of the funds that thinks hope is not a strategy, which is why there is somebody like me that's sitting with that portfolio and saying, what do we do? And so the way that process starts from the get-go is the first meeting is with the founder to understand what their objective is. Look, one of the biggest challenges that I think we will run into is at some point for a VC, if you're forcing a business to go into M&A, you're separating that founder from that business. And very often they've spent 5, 7, 10 years building that business, and it's a big part of their life, right? And we as VCs cannot really be forcing them and saying, look, separate yourself from this business to make me an investment return. The alternative there for the founder is to continuously raise money in the private markets, to continue to do secondary cap table cleanups at successively higher valuations if the business grows, which is completely unsustainable, right? I think this conversation is obviously very timely, but we're in 2025 now. And if you kind of look back at the 10 years before that, which is the vintage that's now going to get realized, the 2015 vintage, total VC investment in Africa in 2015 was $200 million. We've seen this incredible wave of capital, so the primary capital coming into the ecosystem, going 200 million and then almost up to $4.5 billion. What we see in the next 5 to 7 years is also this realizations wave that's going to come. And the pressure to deliver exits and DPI is going to reach levels that I don't think we've ever seen in Africa. And in fact, it's going to be completely unprecedented as a market reality. I think founders also need to be prepared for that to come and expect that this is going to be the future in the next 5 to 7 years. Investors and portfolio managers need to prepare themselves. And the only way we do that is in conjunction with founders. Actually, as Benoit said here, you have to build an acquirable business if you want it to be acquired. No acquirer steps in and wants to clean up a business before they acquire that business. It does not happen. And I think we lack a lot of the fundamental infrastructure to make those companies become acquirable, right? When we talk about Bain, for example, those people are sitting in Europe. They're not sitting here. They don't know the local market context. They don't know the companies. They don't know the consumers of these companies. So how can we not build that infrastructure? Because we're going to see this incredible wave come in. And I fear that we are not prepared for it.
I'd like
Yeah, if I can maybe just hook onto that. That preparation is so key because what typically happens, and people don't often think about it unless you come either from an M&A market or is that company, potential acquirer, again, we're talking about a strategic here, they have to take their own balance sheet money and buy a company that's worse than them, basically, on metrics, because it's less profitable, maybe higher growth. So now they have to motivate to their shareholders, why are we just not keeping the money, indirectly investing in ourselves? Because we want to open another market, or we're buying it for the IP, or it's an acqui-hire, or it's a hopefully sometimes an EBITDA play or a cash play, but usually it's a tech. In our world, it's a different. And because of that, you need to know what game you are playing as a business. If you are going to truly be acquired for your magnificent IP, then make very sure that IP, I call it the thud factor of your IP DD file, can thud on the floor if you had to print it out. It needs to be due diligenceable stuff. If the two lawyers from IP lawyers from Luxembourg sits across you on the table and they ask you trademarks, this, that, you always have. But if it's your people, make sure the ESOP is as maximum as it can and the lock-ins are as long as it can be, and so forth. If it's market access, raise the capital and just make sure there's a land grab strategy that you can say we in, I don't know, 34 countries and whatever it is. So I think that becomes like, what are you selling? How do you prepare for that sell? And it happens so fast when it happens. And remember, these M&A lawyers are experts at driving the valuation down, or the earn-outs, half, or the little sneaky clauses. And you need to be able to meet them head on with why they're wrong. Because of the fact they're going to ask you, why must I take my balance sheet money and do a worse investment than my own company type thing. I think the other thing you touched on a little bit is consolidation coming in the market. We're very fragmented. It's very difficult selling a small company. You talked about $5 million, $10 million. So it needs to be very deliberate what that plan is. You don't exist as a company if you don't have 10 million into an international acquire. If you don't have $10 million ARR, you literally do not exist. So the first goal, secret sauce, is to get our companies to 10 million ARR, just to exist. And then the goal is to obviously swing through to whatever that is. I think it's an important thing that you mentioned about not necessarily, all of us want a unicorn, so that is hope is a strategy in our world, because Knife's strategy is actually to build $100 million exits, $50 million exits, and so forth, and just make sure this is 5, 6, 8 times money, 13 times. But it's not necessarily swing all the way for the 1 in 10 will succeed type model. But yeah, so in all of that lies that gamification of the whole thing. I mean, just before this meeting came from a founder. The investment committee meeting is tomorrow, so wish us luck. But they've got about $5 million of ARR. And the meeting this morning with the founder was like, listen, okay, so the plan is we're growing this firstly to beyond 10. and then to between 20 and 25, and that should take us about 4 to 5 years. And at that point, we're all selling for between 100 and 150 million dollars. That is the plan, and that all founders, shareholders at this stage are in with the plan. I suppose reality will hit the moment we've done the investment, and it probably will grow slow or whatever. But at least we know what the plan is. Even we don't we had the investment committee yet, and we know what the plan is.
So lots of gems here, and I think that one that I'd like to double click on is, and I don't think it's thought about often, but it's about the M&A strategy as well. From a founder's perspective, when you're thinking about acquisition, you can grow organically, but it's also something positive when you have more consolidation in the market. Maybe quickly, I ask all of you what were the good habits, but maybe it could be interesting for you to also share a traumatic experience, like something that happened in a portfolio company when you were sort of heading towards an exit and there's some sort of fundamental mistakes that were made that prevented that. And I think this could be a good learning experience for founders here.
Yeah, happy to start. And I think that goes back to probably 2020, end of 2021. And that was kind of the end of the, right before the VC winter or the private capital winter across the continent, where we took a little bit of a break. Things were correcting. So you had the e-commerce marketplace business doing really well. There was some sort of a consolidation spree happening all across the region. Giant players looking to expand into high value markets. Well capitalized, looking to kind of establish solid on-ground presence, and definitely they have the resources to do so. And I think it's really important to realize the power and the resource and the capabilities of the potential acquirer. And as a company, and to Keith's point here, what are you exactly kind of providing them? You need that kind of perfect stack of everything. It could be the product, it could be financials, it could be governance, legal, everything. Not to make sure that nothing kind of slipped through the cracks. And while spending a lot of time doing this, unexpectedly, I think what we did not focus on is setting out the realistic expectations with the founder of why this is a good exit opportunity, why now, what's the capabilities, what kind of capital we're looking at, or that we need to be able to compete in that market. This consolidator or this player is coming to the market with us, without us, they are coming to the market. But they are way more well capitalized. And I think, mention unicorns, they don't believe in unicorns. And that was actually the discussion, because I think the founder was so focused and taken by the hype of this is going to be a unicorn without actually understanding what is a unicorn, what is an African unicorn, right? And what is the characteristics of it. By the way, I'm happy to call a $100 million company a unicorn because it's relative to where we are, right? It's not about the billion mark. So what we ended up with is company getting little below the $100 million exit value. It's going to make a great amount of money for everyone on board. Cap table was light and clean. Founder was going to make a good amount of return, but he believed that this could get to $1 billion, which was extremely against all market norms, macro conditions, market potential, the opportunity itself in a market that does not or haven't witnessed kind of such type of exits before. So all of these things that we need to take into account while actually being humble, grounded in terms of how we think about it, to assess exactly what is my best suit, where I am, why should I take it, what I should not take it. So I think misalignment on the objectives between why the founder is building this and why, and until when, and what's the belief, what's the mission that they are after, was actually a true break point, or a true point of discussion that led after that to a break point in terms of where we ended up with. Long story short, got an offer on the table. The offer got rejected because this company is a unicorn. I think now, probably 4 years later, they are looking at a fire sale at $1.
I just want to share an experience. Just before the summer, we received an offer from one of the company of Savvy One on the EOR business. And the offer was really fair. And the founders did not accept the offer. They were very hungry in terms of money back, and they failed. the guys, the potential acquirer, went to another potential because you are business, you have a company everywhere. They fail because they ask 100K more than the cost expected, the valuation expected. They lost their future, they lost their money for 100K euro. It means we fail because we should have create a trust with the founding team, and to explain that when you have an offer on the table on a market, on an industry as you are, if you are in the matrix, you need to sell your company. And now we are struggling because we fail with that potential acquirer. So when you have an offer on the table with the key metrics, you need to make the deal.
So something that my experience has taught me as well is that often there's not going to be a better offer than the first offer. Most often than not, yeah. So that greed never helps. Keith,
Yeah, one can definitely. I mean, one doesn't mean one should not take the first. And I mean, you could also back yourself, and you need to obviously understand the market. But came back from Super Return Amsterdam earlier this year, and the message there was a bird in hand is the only bird. Take a partial exit, take a consolidation, just make stuff happen to recycle capital and all the rest of it. And by that I don't mean undersell companies and whatever, but sometimes it's difficult. So maybe just two little things that case studies. But the one business we had a strategic acquired, it was the General Electric exit, but they came and said, listen, here's a term sheet, here's the offer, all the rest of it. And we obviously kind of went back quite, strategically, it's not quite, you must sharpen your pencils a little bit, and that offer is okay, but not good enough. So we were going to subtly reject it unless you increase the offer. And they came back and said, listen, okay, we don't think you understand. The offer is the offer. So it's going to go like this. We either buy you, or they named number 2 on the list. We've got 5 companies we're going to acquire in order of preference. You number 1 for this price, or we buy your competitor and they become our, Africa, or they say no, number 3, number 4. And they went very prepared through the list, and we're like, okay, you can take us. So they didn't increase the offer by $1. We've got other stories where we did increase the offer, so make sure there's a competitive bid, actually. Even if the one bid is double the other one, make sure that there's at least some poker you can play to say, look, I'm also chatting to someone else, and obviously that price can be artificial. It's negotiation 101. But just as a South African company, and this is not a big swipe at the Reserve Bank and stuff, we're working with them to solve all of this and all the rest of it. Garmin exit, we had to explain to them, South African company, that they must do the whole due diligence, do the whole legal negotiation, and at the end, we must apply to SARB, and they can then approve it or not approve it. But don't worry, it's sort of 6 to 8 weeks, and they always say yes. And these guys were like, just sort of run that by us again. You go get pre-approval. We're not even starting this exercise because we also have 2 or 3 other on our list. And versus a company that's Delaware Incorporated or whatever that you just sell. So structuring, exit readiness, important.
Kartik, do you want to close us off by talking maybe about something that happened, but maybe as an advice to founders that it ends in a positive note?
Yeah, I think M&A is super important, but I think the need for competitive M&A processes is also, I think, very important, partly because what will happen is that list of 5, as you said, as we go into the next 5 years, that's going to become a list of 50. And so we're going to see even deeper, we're going to see reduction on multiples on revenue, and we're going to see even deeper discounts on secondaries. So I guess my question or ask to the room is, let's think about alternative modes of exiting as well. Listing, we have to think about lots of exotic structures like management buyouts. We need the people that are willing to finance them, even in asset-light software companies. And I think we need to start thinking about some of those as well, and not just focus on secondaries and M&A, because if we do, I think we're going to see less and less returns as the asset supply goes up relative to the same level of VC funding coming into the market.
Absolutely. I want to thank you all for so much wisdom. I hope that you enjoyed this conversation. This was great. Thank you very much.
Wonderful.